Hello, this is Corner Invest. Today I'll be talking about the best tech stocks to buy and ranking them based on strong buy, hold, and sell. So the first company over here is Robinhood. Robinhood for me is extremely simple. It's a company that I would avoid. So it's in the sell category. So for Robinhood over here, the valuation is not too bad. It's trading at around 28 times earnings, and year to date it is up around 17%. But the problem with Robinhood is it is too tight to gambling, it's too tight to leverage trading, it is too tight to Bitcoin as well. So they're introducing a lot of different types of trading. You have your 24-hour trading for 5 days a week, and they're planning to introduce 24 hours trading for 7 times a week. It is basically turning the stock market into a gambling den already. And then they introduce your zero date to expiry options and all that as well as Bitcoin trading and all your meme coins as well, all into this one app. So for me, I think Robinhood, it is just a company that is extremely leveraged, and that's why I don't like the business. So over here in 2022, when we had a bear market, Robinhood's earnings, their revenue dropped by about 25%. So when the revenue drops by about 25%, you can expect the earnings to drop between 25 and 30% for this business. And that is what you will see in your bear market. You will see this company getting crushed, both on valuation as well as revenue and earnings. So it's sort of like a double whammy. You can see this stock going down 50% in one single year, just when we're having maybe a 15 to 20% bear market in the stock market. So for me, I think Robinhood is an avoid, although it's growing quite well now. Revenue is growing 50%, but I think this is because we had a historical bull run for the past 2 years. And if that bull run stops, then Robinhood's earnings will take a beating. Next stock is Netflix. So Netflix for me, the valuation is trading at around a 46 times earnings now, around a 36 times forward earnings. Revenue is growing quite steadily for Netflix as well. So 15% revenue growth, and earnings is exploding as well. So 61% net income growth. But for me, I think Netflix is a company that is in the whole category right now. I wouldn't sell Netflix if I'm a shareholder for it, but I would certainly not buy into the company as well, because for Netflix over here, for it to sustain a 46 times price to earnings, it has to grow at around 20% or so for the next 5 years or so. And I don't think Netflix can continue growing at this level, because for Netflix, you have a lot of different risk. So you have innovation risk. You need to reinvest your money into creating more films, unlike YouTube. Whereas for YouTube, for example, you don't have to do that because you have creators online that are just producing content already, and then YouTube just pays them a cut of the revenue from ads. So for Netflix over here, for it to sustain, for it to hold this 46 times earnings, it has to grow for by around 20%, 23% for the next 5 years or so, and I don't think they're able to. Their revenue is growing only at around 15%, and although they do have pricing power, you have Amazon Prime, you have Disney as well that's coming up as well. I think Amazon Prime is a company that has a lot of untapped pricing power. So if you were to compare the pricing for Amazon Prime as compared to Netflix, Netflix is around 25, I think $25 here in Singapore, whereas Amazon Prime is only about $13. And Amazon Prime has all your different Amazon suite as well included in that umbrella. So for me, Netflix, I wouldn't buy it. It's a hold if you're currently holding the company, and it's not in the buy category for me. Next stock is Nvidia. So Nvidia is down quite a fair bit year to date. It's down around 17% year to date. Currently trading at around 37 times earnings, 24 times fall earnings. But for me, I think Nvidia is a very risky one for you to buy now, because it is too heavily leveraged on your AI bet. So Amazon, they recently released their shareholder letter by Andy Jassy, and they clearly stated that the AI cost, the AI spending will come down in the future as your GPU become more efficient. So over here, the margin is at around 55%. I don't expect them to continue holding this margin. And they've had explosion in terms of their profit margins over the past few years, because people need to use the Nvidia chips. The Nvidia chips are the most advanced right now. So for me, I think Nvidia is too heavily reliant on this AI story. And so if I'm a shareholder of Nvidia, maybe I'll hold a stock, but I would certainly not buy into this company right now. Next company is Palantir. Palantir is simple. It's a sell for me. Why? Because Palantir is just too heavily priced in terms of its valuation. So if you were to just look at the valuation of this stock is trading at a 400 times earnings. And for it to have a 400 times earnings, it needs to grow 40% for the next 10 years to basically justify this valuation over here. And I don't expect them to continue doing so, especially since you have revenue growing at around 25% or so only. And a lot of their net income growth came actually from the money that they had in treasury. So interest payments, interest income and all that. So for Palantir over here, it may become the next Microsoft, no one knows. But yeah, the risk to reward currently for this stock is just crazy, because you have a company that's trading at 400 times earnings and growing at around 40%. Unless it can go 40% for the next 10 years, I'm not too sure if Palantir can, and if any company can in general, then yeah, this stock is an avoid, it's a sell for me. Next stock, Next stock is Apple. So Apple for me is currently in the whole category. I wouldn't necessarily sell this company right now because the valuation has come down by quite a fair bit already. So Apple over here is currently a company trading at 31 times earnings, and year to date is down around 20%. So for Apple over here, the problem with the business is it lacks innovation. So your revenue is growing at around 2% every single year, and most of the earnings per share growth is due to buyback. So the company is not doing anything now. All it does is it just buys back a lot of your shares, so your shares outstanding is dropping by 3%, 4% every single year. And then you add that with your 2% revenue increase, that is around 8% EPS growth for this company, basically every single year. And for a company that is trading at 31 times earnings, growing at 8%, I don't think it is very fair. I don't think it's justifiable. And that's why for me, Apple is currently in a whole category. Apple has an impenetrable moat, don't get me wrong. But for me, Apple has too little growth. And that's why if I were you, if I were holding Apple, maybe I'll trim a bit, but I will certainly hold on to my position, and it's not a buy for me right now. Next company is Meta. So Meta over here is a company that's trading at 23 times earnings, and year to date it is around flat, so around 7%. It traded down around 30% off its highs already. It went up for a record 20 days straight all the way until $740, and then after that it came down all the way until around $500, and currently now is sitting at $543. So for Meta over here, I was digging into this company in comparison to Google. So apparently, Meta's return on ad spend is much higher than Google. Meta's cost per click is much lower as compared to Google as well. So Google is usually for big businesses, whereas Meta is more reliant on all your different small businesses, your drop shippers and all that. So for Meta over here, it has incredible operating leverage. You have revenue growing at around 20%. You have earnings growing at 59% last year. I don't expect them to continue with this earnings growth for the next few years, but we could definitely see another 10 to 15% in terms of earnings growth over the next few years or so. And for its valuation right now, at 23 times earnings, I think Meta is not a strong buy, but it's certainly in the buy category for me. Next company is Google. So Google is extremely simple. Google is in the strong buy category already. Why? Because Google is a company that is trading at 19 times earnings. So when you have the S&P 500 trading at a 24, 25 times earnings, and you have Google, a much higher quality business than a lot of the other 499 companies in your S&P 500, trading at 19 times earnings as compared to the market, which is trading at 25 times earnings, I think it is worth looking at. So for Google over here, it has a lot of different businesses that are growing quite well as well. You have your Google Cloud, which is growing exponentially. You have YouTube growing steadily at around 14% every single year. Even search is growing at 10%. And although the search LLM story, the search LLM thread, might be a very present one now, I don't see the LLMs replacing Google anytime soon, because Google, they are more reliant on consumers searching for places to go and visit, all that kind of stuff, to go and eat. Whereas for your LLMs, they are currently more for research purposes. And Google is also integrating all your LLMs into your Google search. And so if they can successfully integrate all these different things into search, they could make search one whole big platform that can benefit from all these AI advancements. So for Google over here, it grew around 38% last year in terms of EPS. And I don't expect them to continue growing at 38%, but certainly a 10 to 15% for this company is definitely doable. And when you have a 10 to 15% growth for this company trading at a 20 times, 19 times earnings, then I think it is a very fair price for you to pay for Google right now. And so even though the stock is up around 7% in the past 5 days, I still think Google is an undervalued business that has around a 15-20% margin of safety at this price. So that's why it's in the strong buy category. Next company is ASML. So ASML over here is a company trading at 32 times earnings. So for ASML over here, it is a complete monopoly, and that's why for me, for the quality of the business, it is a strong buy today. The valuation is not extremely high. My fair value for ASML is around $750. Currently, it's trading at around $660. So around a 10 to 15% undervalued for this company. And I do expect them to continue growing as the AI wave continues over the next few years. As Trump tries to bring in all your different fabs into the US, there is another tailwind for ASML as well. And the only possible headwind for ASML is your China innovation in the form of your EUV advancements there. So if all those Chinese companies, they can successfully create an EV machine, then this could be a headwind for ASML. But I don't expect that to have a very permanent impact for ASML, because all your different fabs by all your different foundries, they are all built for ASML machines, and it will take time for them to transition away from your ASML machines towards your maybe Chinese manufactured machines, which may have less yield, which may cost a lot more. And yeah, overall, I don't think it's a very safe bet for all your different foundries to just shift it over to your Chinese made ones. So for ASML currently trading at 32 times earnings, one of the lower ends in the past history, I think it is a buy today. In fact, it's a strong buy today. Next stock is Amazon. So Amazon is a company that is susceptible to consumer spending, susceptible to tariffs as well. So for me, I think Amazon currently it's in the buy category. It's not an extremely strong buy because the margin of safety for this business is not there right now. So for this business over here, the problem with the business is it is still deriving a lot of their revenue from retail. And when you derive a lot of your revenue from retail, you are especially susceptible to consumer spending. And when the tariffs come into effect, then Amazon's business could certainly take a hit as well. I love their dominance in AWS, and for a lot of the different businesses, as long as we see some form of margin expansion, as long as we see some form of efficiency improvement, you could see an explosion in earnings for Amazon over here. So for this business, it grew around 90% last year, and although I don't expect them to continue growing at 90% every single year, I expect them to grow at around 12 to 15% every single year for the next 3 years or so. And so if you have a company that is growing at around 12 to 15% every single year, and for a company that has such a wide moat like Amazon with untapped pricing power, I think paying a 33 times earnings for this company, a 29.4 earnings for this company is definitely more than reasonable. And just year to date itself, Amazon is now around 15% and around 25% from all-time highs already. So you're getting the price at a discount, not at all-time highs. Of course, that is not a reason for you to buy into this stock, but it is a quality business that you can hold for the long term for sure. So next stock is Uber. So Uber for me, it's not in the it's somewhere hovering between the hold and the sell category. Why? Because I know a lot of YouTubers, they've been saying that Uber is extremely cheap, but if you have to just look at the valuation for Uber is currently trading at a 30 times forward earnings. So you may be asking, why is the price to earnings so low for this company? It's because they had a one-time tax expense that led to a surge in their earnings for this quarter. And so if you have to just look into Uber's earnings itself, a lot of its earnings came from other income sources, meaning to say they basically realized their gains in their holdings in companies like Grab and all your different other companies as well. And that is sort of like an accounting way of basically including all your different earnings inside the business. So for Uber over here, if you were to just discount all those capital gains that they had from their holdings in Grab, this company is actually trading at around a 50 times price to earnings currently. And same thing for the free cash flow. So the free cash flow portion, it is made up of a lot from basically your insurance. So they have a lot of insurance cash flow that they take in. The money can be used to make interest, but the money cannot be used to directly buy back stocks. So I did some calculation as well for Uber. The real price to free cash flow is around a 50 times as well. So for 50 times price to free cash flow for a business growing at 20% every single year, that is facing some sort of disruption risk, I don't think it is a very good price to pay, and that's why Uber is somewhere between the hold and the sell category for me. Last company is Microsoft. Microsoft is simple. It's a buy and hold company forever. So Microsoft is in a strong buy. It is the most durable business out of this entire list over here. And that's why I think Microsoft, even though you're paying a 30 times earnings, you can expect to hold this company for the next 10, 15 years or so without any worry, unless the whole world goes bust. Then of course Microsoft will take a hit as well. So I think Microsoft is a very durable business, and that's why it's in a strong buy category, although the valuation is not the cheapest in this entire list over here, but the predictability is the highest in this entire list over here. And that's why Microsoft is in the strong buy category. Hope you guys have found this one useful and invest safe.